Good morning, everybody. Today we're going to talk a little bit about what happens when you have a C corporation and you geniusly ask your tax strategy how to save money. And he said, well, you can convert to an S corporation and you can save on Social Security tax, amongst other things, and not have double taxation. So what does that mean? If you were a profitable C corporation, you didn't distribute all the dividends or the retained earnings out of the C Corp because you didn't want to pay double taxation. So now you come into January 1, you're converted to an S corporation, but you had $100,000 of prior C corporation earnings that you didn't distribute. So the rule is you have to tax that just as if you were taking it out of a C corporation. So when you take it out of the S corporation, that $100,000 is your accumulated earnings and profits over here. And it goes over here. You'll seriously put it over here as a tracking. And it's not the best writing, but when you start your S corporation, your accumulated adjustments account is going to be zero. And you can only take dividends tax-free from here when you have a positive amount. If you do distributions and then it becomes a negative, you can't do that. Those are distributions in excess of basis. Okay, so over here, let's say you're making $100,000 and let's make it easier, $200,000 you made as ordinary income in this year. Okay, nothing else happened here. You zero. You can take out $200,000 as tax-free distributions. Obviously, you're going to pay money. You're going to pay tax on the $200,000 that flows to your personal return. But you can technically take out $200,000. But in a simple example, you have $300,000 now in the bank because the C corporation rolled over with equity. And usually equity, the other side of equity is assets. In this case, this simple case, you had cash of $100,000 and equity of $100,000. So you have $300,000 you can take out of the business, but you can only take out $200,000 tax-free or tax-free distributions from the S corporation. You're really paying tax on that. Don't forget. But there's an extra $100,000. What are you going to do with that? Well, if you do take that out, you would put a distribution over here. And that is going to be reported as basically like a dividend. Okay? And you just have to be careful. The system will tax it. So just be careful. Anytime you take above and beyond what you made in the S corporation going forward, if you take more money out and you reduce your accumulated adjustments account from earnings and profits from your C corporation, those are dividends, and you'll be taxed on that. Have a great day. Thank you very much.